Okay, so we'll talk about a little bit of like who Baileywood is. I'm Carly with Baileywood. That's Kevin. He is our regional manager up here up north. I'm a loan officer with Baileywood. Have you heard of us before? That's okay. So
I'm new here, so.
That's, yep, no problem. So we are, we're located off of like Coldwater and DuPont Road by that Kroger and the Walgreens. Yeah, so we're local. We started out in Indy and that's our Fort Wayne office. We've got offices like in Auburn, Kendallville. So we're kind of everywhere right now. So if you have a client that needs to meet in person, it's pretty convenient.
Yeah,
Yep, it's nice. So with Baileywood, we thrive like on being local. We want to make this like a personal experience. And with that, we try not to just pre-qualify someone. So what I mean when I say pre-qual versus actually pre-approving someone, it means that instead of just taking a look at their file and being like a typical online lender where, hey, they filled out an app, I pull in credit, and then I take their word for it and issue the pre-qual. We take it one step further, we gather their documents, we want to trust them, but verify. Because a lot of the times, we think we may know something and then it doesn't pan out that way. And we never want to put you guys in a bad situation either. So we grab their documents, so their IDs, their W-2s, tax returns, pay stubs, do a verification of employment right away. And then we send that into underwriting. That underwriter puts their stamp of approval on it and sends it back to us, at which point we let you and the client know, hey, you're pre-approved, here's your max, but based off of our conversation, here's actually where you are comfortable at. And we try to give a comfortability range. So if a client says, hey, I'm only comfortable with about $1,200 max, $1,300 a month payments, you probably want to stay away from looking at their actual max of $300,000 homes. That max is more so going to be like 160, 165. So we give that range for you guys and we just make sure those lines of communication are open. So that's, so when I mentioned local versus online, have you had any experience with online lenders or have you had a mortgage before, knowing someone with a mortgage that had a bad experience?
Bad experience, but
Good experience? Was there a good experience more so with a local person or like a credit union? Yes, so local will definitely have that personal touch. We care a lot more. Online, it's very impersonal. They're just there to turn and burn. So we are available outside of that normal 8 to 5, 9 to 5. We're available evenings, weekends, mornings, probably a lot later than we should be, but hey, we're all just trying to make it work for you guys. So the seller concessions, I won't really go into much detail and depth with that, but different programs allow for different max seller concessions. For instance, like a VA loan, you can actually pay off some debt with seller concessions, whereas any other loan, you can't really do that. They're going to have different percentages based off of different loan to value. It is always imperative though, just to ask your lender, hey, do we need seller concessions for one? For two, if we do happen to get some, what is the max for that program? That way you already have it for that specific client and you're not trying to calculate it yourself or trying to remember, what did she say in that first meeting in my first 2 weeks of becoming a realtor? So always just check with us. Rescoring credits. So let's see, is there, okay. With rescoring credit, we have a lot of clients that will say, hey, we're not necessarily ready maybe to start the pre-approval process. We have some things to work on. No problem, send them to us. We'll go ahead, we'll work with them getting their credit up. We have a team dedicated to building those plans. When we get that plan out and we send it to them, if they are immediate, like, hey, we want to work on this and they do the job, we let you know. If they don't do the job and we follow up with them a few times, say, hey, we're going to put them on the back burner for our nurtures. They're not willing to do the work, but I'll follow up with them in about a month or two, see where they're at with things. If they do get the job done, we'll let you know, hey, they are now in qualifying range. We're going to go ahead, get them pre-approved, and then we'll send them back to you. So that way you're not stressing out about their credit. We're the ones taking that on. We do have appraisal gap strategies, but we'll go into that maybe on about another day where when the market starts to heat up, and we'll kind of do a class specific for that, because it does get in the weeds with that topic. Just know that, hey, if you have, your finger in a multiple offer situation, we can tailor something specific to help with that. So the entire loan process from start to finish essentially is you have the client, send them to your preferred local lender. From there, we get them pre-underwritten, we get them pre-approved. We send back to you, they go find a house, put an offer in it, you write the best offer ever that gets accepted. They come back to us now to start that contract. When we get them, we have to send disclosures out within 3 days. But we make sure we go over the loan estimate. The loan estimate is a very imperative step in the process where they need to know all of their fees that they possibly may incur. Doesn't necessarily mean that they will incur them, but it is always important to set that tone. We take it back to underwriting after we get anything that updated that we need or anything that was listed on the initial conditional approval. And then we send that back into underwriting. It comes back to us. They go ahead, they get their homeowner's insurance, take any home buying class that they need to, send it back in for that final approval and the clear to close. Once we have that clear to close, you are okay to go ahead and schedule. Try not to schedule closing until you have that clear to close. We run ahead of schedule. So if I say, hey, we're actually on pace to close like a week or two early. That's not the okay though, to go ahead and schedule closing. That's just saying, hey, if you're okay with that, we'll keep things moving along and we'll be ready to go early if the seller's okay with that too. Our average close time is usually in 14.2 days, I think, but I would just round it up to 15 days at this point. Yeah. And that's because of that pre-underwritten step. So that takes about 4 days out of that whole process right there. Have them pre-underwritten. Another big perk of having somebody pre-underwritten, especially on not conventional, sorry, the government loans. Government loans are anything that ends with an A. So FHA, VA, USDA. We have to run what's called CAVERS. CAVERS is a special type of reporting system that does a little bit deeper check. Once we run that and say that's clear, because not everything does show up on the credit report, that's usually a good step to take care of the pre-approval. So nothing will, unless it has to do with the appraisal or they change their current situation, it won't fall through.
So you're saying it's longer for like the federal loans?
I do find the government loans, sometimes they'll take a little extra longer, but anything can kind of delay anything. It stop employment income, if they are, government loaned and we need to run extra checks, send it out to USDA. So like USDA guaranteed versus USDA direct. USDA guaranteed is what we offer. It's 100% financing, but we do have to run what's called GUS, which is another automated underwriting system. We have to send that out. And USDA actually has on their website how long or how far out they are with applications. Usually it's within a day or two. But if they do fall behind, that will then delay our approval process as well.
Yeah, to add to that, so once we're finished with everything, we'll take a completed file. USDA is the only one who do this, but it's a completed file. We have to send it to USDA and it sits in a queue and they just first in, first out is how they work on it. So as soon as we see it's a 2-day turn time with USDA, we throw it in on a Monday. We know typically Wednesday, we'll get that back from USDA. USDA is reviewing the income, the credit, our ratios. They're gonna say, hey, yeah, we like what you done, signed off, they call it conditional commitment. So boom, there's your conditional commitment. Our underwriter gets it, they can now officially clear to close the file. So that's what she means by getting more election days.
Those ones are a little, you're not gonna remember everything about to do with the loans, that's our job, but anything that kind of helps you like structure a deal or anything, just give us a call so that way we can run through it and make sure everything is like completely understandable with you or the client. We just want to make sure that everybody's on the same page, and as long as we have open communication, we'll be just fine.
I'm kind of curious to how, because I know when I looked at houses with my agent before, she would say, oh, this one would be okay for USDA or FHA, but
That's a good
she
point.
usually knows. So I
Yes.
want to know. You know what I mean?
So that's a great point, great question. So USDA, VA, FHA, they're going to follow appraisal guidelines based off of what sound and safety standards are. Conventional, it's a little different. So when you see listing terms, when you pull up like the MLS or even on Zillow, it will have the listing terms. And if it says cash and conventional only, that means your buyer can only either offer cash or with a conventional program.
Oh, it's there.
Yes.
Gotcha.
Yeah.
Okay. I
Yeah,
thought
so-
she just knows that.
A lot of agents will put on there what it is.
Gotcha.
Yeah.
There's also, to expand on that, appraisal, components of that, you'll know, hey, this has got some, we always joke about health or safety issues. So, for example, chip peeling paint, lead-based paint, so chip peeling paint will have to be fixed in order to go USDA, FHA, or VA.
Okay.
Yep. There'll be quite a bit of, that will come to with experience.
Yeah.
That's nothing we can like rush. It comes to me with experience. He has way more experience than I do, so he would be able to look at something and be like, got it. I'll look at it and I was like, okay, let me look through some pictures. I think I'm gonna double check, but yeah, that's not gonna go.
We always joke around, it's optics,
Yeah.
what it means by that is a handrail to the base of that. Nobody really thinks of that, and all of a sudden the appraiser comes back and is like, oh, it's an FHA one, you can hand it up to the basement. Great.
I think the weirdest one I got was, okay, you know how when you enter a room and maybe the flooring has changed? So carpet to carpet, if there's not like that metal strip holding the carpet seam down, they want that added. It's like $10. You can go to one, like a lot of the fixes aren't expensive by any means. And if you like, when we get that appraisal report back, we will typically say, hey, these are what need fixed. If you need recommendations on how to do so, let me know, because usually it's a quick fix and an easy one and an inexpensive one. So instead of paying somebody $1,600 to maybe like fill a crack in the concrete, there, you can get a $5 bucket at Walmart, fill that in, sand it off, and you're good. So it helps a lot. So minimum down payment. So let's talk about that, because you'll get a lot of buyers, that will, I would say 80% of my files, it's minimum down, or they need assistance. That's okay, that's what it's here for. So with conventional, you're gonna have Fannie Mae and Freddie Mac that back that, they're like brother, sister. Sometimes one's more temperamental than the other, so we take it to Freddie or we take it back to Fannie. They're brother and sister, so they fight. They have different programs within these programs as well. So you're talking about, it has to be based off of income. So if they're a first-time home buyer and they make below the 80% of the area median income, their minimum down payment's 3%. They also have 100% first-time home buyer AMI program, which their minimum down again is 3%. So it's going to vary, but the first thing that you need to know, just call the lender, let's talk to them about it. Do you have anything, do you have any recommendations as to what they can go for? As there are credit requirements per program or in order to qualify for a lower down payment. With FHA, I get this a lot. First time home buyers think FHA is because it's 3.5% down. Way back when, that was the program for first time buyers because of the low down payment. Well, now it's not anymore. If you have somebody like a 780 credit score and they're wanting an FHA loan, say, hey, I want to hear why you want that. I'm going to show you an option that actually might be better for you. What are your thoughts? So we take a look at, maybe a 3% down program or 100% loan to value program. So your VA and USDA, they don't require a down payment. That one is, so if you have somebody that's looking in the rural area, we can put together cost analysis, show them the difference between conventional and USDA program. Most of the time, they're gonna wanna do USDA, unless they have a ton of money.
So we got somebody that could do FHA and conventional, so why would you do FHA? You know what I'm saying? Like, why would you choose between the two? If they're pretty much the same.
So it's gonna be based off of rate and PMI. So FHA, if you have a borrower that's in that tough range of like, say, 680 to 710, if they can go FHA and that they can get an offer accepted, your PMI is gonna be a lot less and their rate is probably gonna be better than what it would be on conventional because of those loan level pricing adjusters. And that's where we show the comparison side by side. So if they have the funds for 3.5% down and to cover their closing costs, I'm gonna say, hey, this is what's cheaper for you monthly. Here's what it would cost you over 5 years. What are your thoughts on doing this versus conventional? And we give them the options. And conventional will get you a stronger offer, yes, but is it best for the client in every situation? It's going to vary based off of a very specific situation.
So FHA, you can have lower credit score.
Yes.
Yeah, so FHA, FHA is more, lenient on the credit requirements for a loan, so lower credit scores. Higher bankruptcies. They also, to Carly's point, and now we have this frequently of, hey, you're better off FHA, but a house they really want to buy and off of it won't take FHA. Okay, well, you can do conventional, it's gonna cost you a little bit more per month. But what she talked about with like credit rescore and things like that, there's things we'll do to help them in the future to say, hey, it's not a long-term loan, we will refinance them, so let's go conventional, let's get your credit score up, in the meantime. You know, we can help you guys secure that property conventional, because it won't go with HA. So our, Carly's big thing is creating options. And options then, and it varies from house to house. I tell people, hey, FHA is gonna be best for you, but we'll go look at houses and we'll decide once you find one.
Absolutely. Audrina, do you have any questions at all? Does this all make pretty sense to you? Okay. Last one. So down payment assistance. This one is pretty popular. So we do have an in-house down payment assistance program for FHA that'll give them their down payment, the 3.5%. The rate is a little bit higher. There, it sits as a second mortgage and there's interest on it. The down payment assistance program through Indiana, we also carry. So that one is going to give you 6%, and that's offered in conventional or FHA. And the best part about that is Indiana actually sets the interest rate. So regardless if you have somebody with a 650 or 680, they're still gonna have the same interest rate. There's no points associated with that. So when Indiana Housing has the 6%, so that if they're conventional, it covers at 200,000, they get 12 grand. So their minimum down payment is 3%. So 6,000 of that, of the 12 goes to their down payment. Then they have $6,000 left to cover their closing costs. Indiana does charge a 1% origination fee. So I would say, yes, they do give 6%, but they take 1%. So they're really getting 5%. So then they have now, okay, only 2% left to cover their down payment, since that's $4,000 to cover their closing costs. So usually their earnest money then kicks in and takes over, and sometimes they'll get some money back, usually around that 200,000. I typically do incur that clients will get a check back at closing with some of either all or some of their earnest money back. Larger the purchase price, the more assistance. The lower the purchase price, the lower amount of assistance. So 100,000 only get $6,000. 200,000 are gonna get $12,000. So it is catch-22 on that, but they do have that assistance sit there as a second mortgage without any interest collecting on it. They don't make payments on it. It sits there until they either one, sell the house. It is not, because this is a non-forgivable DPA. If they sell their house, then it comes out of the equity of the home. If they refi, again, it comes out of the equity of the home, or they have to turn around and pay it. That is a ballooned payment of whatever that they borrowed. So when I tell people that, it kind of makes, what are your feelings about it?
So you can't pay it off.
You can pay it off if you want, but it sits there as a second mortgage. Okay. I always like to ask like how people are feeling about that. So that way I can kind of take away some of any negative feelings that there might be. So some of the objections that you may come across too is, well, if I pay out equity, why should I even do this? And the point of that would be because your home will appreciate in value for history, but that you have not been able to save that $12,000 up to now. What are you gonna do to change to go ahead and save that $12,000 in the next year? Is that possible for you? No? Okay. So now the equity in your home keeps growing. You're in a house, you're building wealth while $12,000 sits there. Yes, it's a debt that you may owe in the future, but that sits there and does not collect any interest on it.
I see what you're saying.
Yep. There also is called what's next home. Next home is gonna be for next home buyers instead of first time buyers, and they give anywhere from 2.5% to 3.5% for the down payment. Okay, so with the mortgage market, what causes rates to fluctuate? Well, a good thing that we were talking about earlier, the CPI report came out, and the inflation basically, it wasn't good, so now rates aren't. Yeah, they're starting to go back up again. They're starting to tick up. So there are a lot of different factors in the market that's going to cause rates to fluctuate. The the important thing about either a floating rate or a locked rate is a floating rate is always an estimate and can change. A locked rate is something that is locked in, it will not change for the life of the loan. We do something that's interesting called a rate lock float down, and that's when a client goes under contract today, we lock their interest rate in, say they were locked in at 7.25%. By the time that they close, hey, the rates have kind of come down. And now we can actually put them at a 7%. We'll do that, and I've had Bailey would do that a night before closing, where it saved the client basically 0.25% for their interest rate. So we will do that, but once that loan is closed, it is done, and that rate, it does not matter until they refi, they're in that interest rate for the term of their loan. When we float an interest rate, it's, hey, we're not under contract yet. And so when we sometimes we'll send a loan estimate and we'll say, is the rate locked, yes or no? If it's no, that loan estimate is kind of invalid. When it's marked yes, that loan estimate is valid.
So they get locked in once from under contract.
Yeah, and they'll get rate options too. So are you familiar with what a discount point is?
Yeah, some, but I'm still kind of.
Yeah,
Looked it up.
there's a lot that will go into that, and that'll be on a different time again, because it's kind of basic,
Is
but
that the one where you buy points?
Yes.
To lower?
Yep.
See, I understand that part, I just don't understand like how to calculate, like.
when it's worth it,
Like if it's worth it, you know? what
Yeah,
I'm saying?
correct, yeah.
That's like.
So-
Yep, and it,
we'll do that.
yeah, and it's, so back in the day, it used to be 1 point would save you, you know, 0.25%. So a lot of people in their mind think, oh, well, if I'm gonna do 1 point, one discount point, I get a 1% cheaper interest rate, and that's not how it works.
Yeah.
But what I tell people is the market is so, markets used to only update once years and years and years ago. Now they update daily, like while we're sitting here, I got a market update. They update real time, just like the stock market does now, is what mortgage market does. So to say it's, you know, hey, 1 point gets you 0.25%, well, that might be for retrieval at this specific time, but 4 hours later and another client later, it might be 1.5 points, might get you 0.25%. So that's where for us, it's part of the scenarios, it's part of what we look at, it's part of, I always call it break-even points. Like, so what is your break point? When do you start saving money before buying that rate? Because it costs you something to get it. So at what point is it worth your $1,000 to save $15 a month? Does that actually make sense
Yeah,
in that situation? So that's what we do most of our days, is kind of crunch those numbers and
yeah.
then, you know,
You actually get people to do it like normal home buyers. Yeah.
yeah, actually, well, like today, I had a guy already text me about, he's like, hey, you mentioned something, we're not closing for a month, so I said, hey, let's let this rate go for a little bit. And so he said, hey, I saw you mentioned the CPI report, it came out, it doesn't look great. How much that, should we hold off longer? Should I lock it in now? What would the points be? Because we've had those conversations, so now he kind of understands that aspect of it.
Education is probably our number one
Yeah.
thing that we do stress. So, and you'll get copied on the emails too for the rate options. Like if you want that and the client is okay with that, we'll copy you on it to show like, hey, like this is where we're gonna kind of go with. So when he was talking about like the break even, so if it's 1% of the loan amount and say it's $1,000, it's $100,000 loan, $1,000 is then one discount point. It takes the interest rate from a 7 to 6.625. What's the difference between that monthly payment? Say it's $100. And I'm just saying these numbers for easy math. So we take that $1,000, how many times does that 100 go into that 1,000? Well, it's 10 months. So in 10 months, that's when they have started to recoup their money, and then they're gonna go forward with savings. With the rate breaks that have been built in this year, and as we know, what the feds like to do is delay everything, we take that into account. So I'm not gonna go ahead and say, hey, I think you should buy 2 or 3 discount points, because at this point in the market and where things are gonna head to, that would be almost wasting that client's money. But I give them that choice. I say, hey, if it doesn't bounce back, here's where you're starting to recoup your money, but if rates are still bad. If you want to continue with, the 2 discount points and you really want that lower, like a 6.5, and you're willing to take that risk, that's okay too. We'll just go that route. Ultimately, it is the client's decision. Our job is to show them when their break-even points, as Kevin said, is, and then when it would not make any sense. So spending $10,000 in prepaid interest, you might as well just throw that at the principal of the home, see if we can avoid a loan level pricing adjuster and go from there.
Yeah.
So,
So I feel like a lot of people I know don't really wanna come up with a bunch of money to start with in the first place.
Yeah.
That's why they want like such low down payment, you know what I mean?
yep. Oh, why do different people get different rates? When I mentioned loan level pricing adjusters, that's gonna be based off of how much they're putting down. And then their credit score is probably the biggest one. So if somebody with a 780 credit score is going to have a better pricing than somebody with a 610. So someone under 620, it's gonna be very costly. So that's when we jump in, even though we can do it, we say, hey, I'm gonna see if this rescore is gonna be better, and here's why. If it takes them only $600 to pay off a card and it shoots their credit score up to 640, 660, they're gonna incur way cheaper pricing and save them thousands of dollars, not only up front but in the long run. So we do take a look at those options to see what's gonna be the cheapest for the client now and in the long run. Mortgage calculator. So a cool thing about our Mortgage Express app is going to be that mortgage calculator. It allows the client to jump in, play around, and see what their monthly payment may be. We always do encourage them to say, hey, if you're gonna go look at a house and you're really interested in it to make an offer, please reach out to me, because I can run numbers. I'll look up the property taxes. I try to tell them, don't rely on Zillow to give you the property taxes. Allen County, Indiana, it is public. You can access that publicly. You can pull in the tax bill and see what the deductions are on there. Because we may have somebody that's looking at a second home that is going off property taxes for somebody that is over 65, disabled, and it's their primary. Okay, all three of those exemptions are gonna cut their tax bill pretty low. And now that person's second home thinks maybe the property taxes are only $80 a month, when in reality, they're $300 for them. So we always just encourage them to reach out to us.
Ma'am. Hi, friends. How are you?
Good.
Secret.
Oh, and another cool thing too about the app is you do get notified on your client's progress. So if Kevin is our client and you send them to me, we go ahead and send them to underwriting and processing. You're gonna get that milestone notification update to your phone. It's gonna go from processing to underwriting back to final approval. And then you're gonna get the notifications for clear close as well.
You got that? The scan thing?
Oh, yeah, I don't know if you wanna try and
I'll just do it.
okay, yeah.
It's a-
I can also get your information and send you like an actual link for it. Cause we can co-brand it too. So when you send the app to your clients, it'll have your information right there on it.
Yeah.
Yeah.
So, in that aspect, which is like you, she says it kind of co-branded thing, it actually is a track.
Yes.
So you actually can share it, when you share it to a client, either through text or through email, you're like, hey, well, let me send you my mortgage letter, what's your phone number? You'll put that in your phone, you'll share it to them, she gets notified. She'll get notified, and then it'll show you up top.
Yeah.
So now they can, when they get an app, it'll show you, and then underneath it'll show Carly,
Oh, no,
and then you can see all the long updates.
So this is the app. You can, we can co-brand it to have like your picture there, and then, your information here too. And that way, when you share it with the client, they'll see and open it, and it's like your app as well. And then you'll be able to get all the milestone updates and all of your client lists like right here.
Sure, so it just kind of throws in there a value, but if you're sitting there, like I have a bunch of agents that'll sit there and they'll look up and they'll say, okay, you have taxes are 1,800 a year, they'll throw in 1,800, and they'll say, okay, homeowner's insurance. Some of them will ask, what do you want? Because that's all we're doing is estimating. I'll say, hey, put 1,500. They'll put 1,500, they'll spit out the payment, and it's usually within 5 or 10 months. So then they know, clients have that peace of mind of, okay, I feel good with that payment for this house at that price. Gives you a little bit of peace of mind too.
Yeah, like that. I have a question. I'm sorry.
Oh, no, we're good. I was gonna say, if you guys have any questions, now's the time to ask, because that's the first hand, but.
Just like, whenever we buy a house, we always go with like direct to the bank. So can you tell me because I feel like we're always like with either a credit union or you know what I'm saying? Like, how do you determine a mortgage lender or something?
That's a good question.
I already know the answer, but I'm kind of.
But nope, you're fine. So, banks, they'll house your money, they'll, do auto loans, they'll do HELOCs, they'll do a bunch of other stuff. And then a lot of the times they have to outsource their processing, or they're very limited in what they can do. So, they may only do a conventional loan, the Partners First, only conventional, Three Rivers, they have to outsource every government loan. And they can only do like Fannie Mae with conventional. Whereas like mortgage lenders, so Bailey Wood, we specifically only do mortgages. We have in-house processing, we have in-house underwriters. You can ask an underwriter, we have an underwriter queue that's open 24/7. We have direct access to our managers, as much as I'm sure that they love getting calls at 10, 11 o'clock at night. Kevin's a workaholic, so it's fine. He's like, we just have a lot more support in that sense. We have a budget too for marketing. So banks, it's on their dime. It's on that loan originator's dime. It is not necessarily on ours. We can go ahead and split things. So if you want to run flyers, okay, we have a marketing team that is phenomenal, by the way. Colleen and Emma are probably the best in the business out here. And Leah does videos. She's down in Whiteland. There's endless stream of possibilities with Popeyes, open house, any type of event that you want to get to with the public, any charity that you really passionate about and want to do something with, and build like a brand with that, we can do that. We can co-brand with you, split costs. We're a lot more easier to work with our flexibility. Yeah.
So you have, to break down, you have credit unions governed differently, banks governed differently. We're independent mortgage bankers, and then you have mortgage brokers. So a mortgage broker, they're kind of more of a thing in the past. They're still around a little bit. There's not a ton of them, but to her point of everything that we do is in-house. So when you send us a client, we're doing the loan, it's Bailey and Wood through all the way. If you go to a mortgage broker is looking at this lender, this lender, this lender, this lender, that lender, that lender. Yes.
Yeah.
And so what they'll do then is they collect all the documents and then they look and they're like, okay, who's got the best offer for my client here? And then they'll go send it to them. That's a little bit, she was mentioning like Three Rivers, for example. Three Rivers does a fantastic job. They have their unique programs, like on the construction. They're top-notch construction program. We will refer our construction stuff to Three Rivers. You don't find anybody better. Three Rivers they don't do FHA, USDA, VA in-house. They actually broker that out to an independent like us, but they don't do it with us because we don't need that business, so we're not gonna pay them for that business. Instead, we're gonna partner with you guys for that business. So what happens in that situation is sometimes you get two sets of closing costs. You'll have closing costs for Three Rivers, and then you'll have closing costs for, Van Dyke Mortgage, because that's who they're running it through. Or vice versa. So that's the difference, is the broker shop will send it. We are direct lender, meaning we are direct with Fannie, we're direct with Freddie, USDA, VA, FHA. It's all in-house, never use our hands. From a cost perspective, everybody's typically around the same kind of range of cost. Like you might have a few $100 variance here and there. The difference that you get with us, obviously, is our speed. Our average turn time is like 14 days. I just told Nate yesterday, I think we're averaging roughly 9 to 10 days. So we can get a file. So if you have a cash transaction that doesn't want to close for 2 weeks, that's kind of what we are as well. We can close it that quick. The bank and credit union, they gather so many other things. Mortgage is one of the revenue streams. So I used to work at Chase Bank back in the day. I left Chase because Chase had zero desire to actually originate loans. So I was literally referring loans out to somebody else. They were doing the loan and then Chase was buying the service. They want to have the service and they want to have that mortgage on the books. They just don't want to originate it. So for me, as an originator, I was thinking, I can't do this. I'm referring business elsewhere that we won't do, but yet we're buying the service back. And so that's where I jumped ship and went to the independent side, because I said, okay, I want to have a whole slew of products we can offer. I want to be efficient. We want to be quick, effective. And for us, the difference for us in online, like Rocket, #1 lender. in America, it's a transaction. It's not a relationship. There's no component of it. They try to make it seamless. They try to make it quick, but they try to do it all through technology. There's no personal human touch. So for us, it's, if all of a sudden you've got something that's site that's at 8 o'clock at night, and you have a paycheck writing on this, Rocket doesn't care. Carly cares. So Carly's gonna pick up the phone and say, okay, well, let's take a deep breath, let's calm down, what's our issue? And then let me try to solve it, let me get with the team, let's try to work together, because that's all we do. Like, we're here to support role, just say, hey, how can we partner with you guys to make you guys? Because there's so many, you said, well, I'm guessing you saw with Angie in a title presentation, you've got to go procure your own clients, you have to then write contracts. The last thing you want to do is become a mortgage expert. So we say, hey, how can we partner with you? How can we have that open line of communication and maybe that take that stress away from you? And we're a resource. That's what ultimately we want to be. And I think we talked about this, but I always tell people too. We don't want to be your only lender because we know, I mean, like we talked about, like Three Rivers. Carly has a couple people at Three Rivers she partners with. I have Three Rivers I partner with. So I always tell people, you want to have a connection at a bank and a credit union, and you want to have at least a connection with the independent side. Because, I always tell people, you can send everything to us, we'll gladly do it, but there might be times where we call you back to say, hey, this is what they're looking for. They need this product, this is the best place for that product. So people have kind of a niche, and we try to focus like, hey, we know we don't do portfolio loans. Portfolio loan is 100% in-house. Because we don't have checking accounts, savings accounts, we don't have our own money to lend. That's what banks and credit unions do. You go in there to put deposits in there, banks and credit unions use your deposit to lend out in auto loans, in mortgages. We don't have that, so we're not going to keep the mortgage on our books per se. So what we're gonna say is, hey, go call Adam Fussell at the real estate bank. He will portfolio this loan all day long. You'll call Adam, they'll do the loan. So it's things like that that we was looking for. We want to be, obviously, your number one, we want to be your number one resource, but we know that we can't do everything. And there's certain products that are better suited elsewhere.
You would?
I have a lot to learn.
It will come in time.
Yeah.
And like I said, we want to be your number one resource. If you have questions, you can reach out to us and talk, like, if you ever want to get coffee and just, yeah.
Yeah.
Even if it's.
And guess what? In our world, guidelines are gonna change in 2 months.
Oh, yeah, they're always moving.
The rules constantly change.
Yep.
So, yeah, I tell people like,
It's like that wherever they are.
yeah,
All right, guys. Well, thank you so much. Thank you. It was nice meeting you though.
yes.
Me too.